So if you can hear me, we're launching you now on the Fiduciary, Capitalism and ESG session. And of course, we're going to focus now on governance. And Olivier is bringing you on the mainstream on YouTube, Zoom, LinkedIn, and audio. So we're launching you, and to use a Greek word or French word of Greek origin, reference to Aristotle, give us the quintessence of your thoughts on the issue. Konstantinos, the floor is yours.
Thank you, Nick. Good afternoon, everyone. I'm delighted to be a guest speaker in the G20 Pensions Forum. I'm also delighted to co-chairing the session Fiduciary, Capitalism, Innovation and Impact. My presentation will be very brief and will be focused on how we can nudge market actors to become drivers of innovation and then achieve impact on their side as far as their overall impact upon the investment chain is concerned. So I will be referring and interchangeably using terms of institutional investors and asset managers and also proxy advisors, because we have to watch holistically the whole investment chain and all the different market actors. Now, let me start by the crucial point where we currently find ourselves. We have the current ESG trends that are a main expression of course, market trends, but also depict very unfortunate or difficult or challenging realities. So if we start with the environmental factor, we know that the climate situation is not ideal. And of course, in my adoptive hometown, Glasgow, where I live and work, we will have a small conference entitled COP26 in a few days. But I would like to stress the fact that notwithstanding the outcome more or less ambitious of the COP26, the attention needs to be always brought closer to the market actors. So I find, to be honest, much more important the fact that yesterday 733 institutional investors representing more than 52 trillion of US dollars assets under management wrote the letter and joined the that kind of collective announcement to governments arguing at the global level that we should move away from fossil fuel subsidies and phase out coal and also mandate climate risk disclosure. This is what we need to see. Politicians, governments and policymakers, of course, do their work, and we can all expect different things from COP26, but it is ultimately market actors who can drive the agenda forward, not in order to set the guidelines. The guidelines will be always set by policymakers. But once we have these guidelines set by policymakers, for example, if we talk about climate change and fiduciary capitalism, so if policymakers moved with the offsets and the net zero strategies have been mainly channeled in the market and in policymaking processes via offsets, we know at the same time that market actors do not appreciate offsets too much, because offsets can bring you up to a certain level, which is basically ticking the box and offsetting your carbon emissions, but do not drive you even further, which means they do not nudge you as a market actor, company, or investor to actually go and prove that you have a further, much more productive impact upon a nation's economy in relation to climate change and all the risks associated with that very unfortunate situation in which we find ourselves right now. So what I'm trying to say is that notwithstanding a positive or less positive, more or less ambitious outcome of COP26, more attention needs to be paid to market initiatives, to coalitions between investors, asset owners coming together in order to form coalitions and pushing policymakers, but also pushing companies, of course, via their engagement policy and collaboration with other investors when they engage with investee companies or when they invest in infrastructure or private equity, to actually nudge and also push for more meaningful agendas. Policymakers will be doing what they have to do in order to satisfy their own agendas, which are mostly rational and of course fully respected by all of us, but the market needs to move forward and drive change towards higher levels of efficiency and also initiate mechanisms that will prove to be much more determinant as to how we tackle climate change, but also as how we tackle social and governance issues. Now, coming to pension funds, our topic for today, what I have supported publicly and also via various articles in my research is that these kind of coalitions between market actors need to be also supported by soft law mechanisms. For example, as far as engagement policies are concerned, we do have the Shareholder Rights Directive, but at the same time, we have seen that some member states in the European Union, and not just, of course, in the European Union, market actors themselves have come together in order to create their own soft law mechanisms. When these soft law mechanisms are in place prior to the directive, we note that stewardship is embedded in a much more productive way and engagement policies are much more evident. Where such market initiatives are completely absent, and then we just have as a member state to transpose a Shareholder Rights Directive 2, asking from asset owners, asset managers, and proxy advisors to disclose how they engage, or in the case of proxy advisors, which kind of methodologies they adopt when advising their clients, we see that the stewardship momentum and the fiduciary capitalism momentum is much more difficult to build. So what does this tell us? Is that in a concomitant way, in a simultaneous way, we need to keep on nudging market actors to keep on creating coalition and also soft law initiatives. As I have been liaising with the Pensions Forum and the ESG Summit and the Singapore Economic Forum, hosted very kindly by Nick always, I have been also advising MEFOP, the Italian Ministry of Finance organization in charge of pension funds in Italy, and we have been preparing steadily a brand new soft law instrument, which will be entitled Stewardship Guidelines, applicable to pension funds and not just pension funds. We will be in a position to publicly announce them end of November, beginning of December of this year. And what we have seen so far, talking with various market actors in Italy, is that this kind of new soft law instrument is much more likely to inculcate this kind of mentality I was referring to before, instead of just expecting from pension funds to keep on complying with numerous and constantly evolving hard law obligations. So focus on soft law, focus on coalitions, provide incentives to pension funds, but also enable pension funds to become aware and develop their own engagement policy and their own awareness on how they can engage with investee companies, or most importantly, when they delegate the engagement function to their asset managers, to then be able to select asset managers with more awareness, but also to challenge asset managers during the lifetime of the mandate of the delegation, in order to create this kind of more prolific and more productive relationship with asset managers. One of the biggest problems we currently have with asset owners is that they struggle to communicate effectively with asset managers. So summing up my intervention is, I feel that we will see more and more market initiatives. These market initiatives are much more likely to bring more concrete outcomes without compromising, of course, or undermining the rational and well-respected and welcomed policy making initiatives and governmental initiatives. But the pressure needs to come from the bottom. The pressure cannot just keep on coming from the top. Mentioning the pressure coming from the bottom, I also want to remind all of us that when we discuss about pension funds, we now have to deal with also the evolving and constantly changing behavioral patterns of the Generation Z. It's not about millennials anymore joining pension funds. We will have in few years down the line, the Generation Z becoming employees and being able to contribute to pension funds. If we want to have them on board, and if we do not want them to go and invest their savings in other finance methods such as Bitcoin, or with all the blockchain technology, or even other platforms that they lack transparency, we need to make sure that these people will be aware of what they do when they invest their money in a pension fund, and will be also given the right to voice their opinions. In the UK, we have fintech companies right now, such as Tamelo, which basically enable you via the app of a phone to keep on sending advisory votes to your asset owner or to the asset owner's manager in order to say what you expect from your pension to do. how you expect your assets to be channeled, where do you expect your assets to be invested. So we need to make the systems that we have, the current systems, the investment chain that we have, much more user-friendly and much more accessible to the ultimate beneficiary. This is the trend, because I fear that if we do not come closer to the Generation Z, from which we expect more and more and more contributions in the future, capital markets and pension funds might become, if not obsolete, but might become out of trend, because they are in constant competition with much, much forward-looking and much, much more immediate and instantaneous fintech financing and investment solutions. Thank you.
Great, Konstantinos, and from Europe now to the US East Coast, and we're going now to Boston to your colleague and friend. Can I see him on the screen? Yes. Bonjour, David. And glad to have you both with us today. And so moving now to Boston University School of Law, your peer and camarade de jeu, as we say in French, David Weber, who will give us his more US perspective on S and the G. David, the floor is yours.
Okay, well, thanks as always for the invitation, Nick, and Konstantinos, good to see you as always. In fact, some of the remarks that he was just making tie in perfectly to a couple of things that I wanted to talk about today. I often feel like I like to do the sort of news flash regulatory or other market update from the US. And I think, as I said last time, for several years, it was always, I felt like my segment at this conference was always the bad news from America. But now things seem to be moving in a better direction today. So at least for those of us who care about the issues that we've convened on today. So thanks as always, Nick, for putting together a great conference. There are 2 points that I just wanted to make now, 2 kind of updates that I think give us a sense of where the landscape is right now. First, I wanted to talk about some interesting news out of Blackrock, which announced a policy this week of turning over as much as $2 trillion of its voting power back to pension funds that invest with Blackrock. And I also wanted to touch a little bit on the sort of latest out of the US Department of Labor, which, as I know our audience knows quite well, has jurisdiction over many of these kind of pension fiduciary duty questions here in the United States. So first up, some interesting news out of Blackrock. BlackRock announced that it is going to be turning back over to many of its investors, particularly its pension investors, the decisions over how to vote those pension investors' proxies. Historically, if you wanted to invest with BlackRock, which, as we all know, is the largest, private asset manager out there, if you wanted to invest with BlackRock, unless you had separate accounts, basically BlackRock voted your proxies for you. You could negotiate to have separately managed accounts. Often that was the kind of was available only to sort of the very largest pensions and so forth. But otherwise, basically BlackRock voted your proxies. Well, last week, I should say, BlackRock has announced that it is going to introduce new programs for 22, for the next proxy season, that would allow pension investors to vote their proxies. And there are a couple of mechanisms by which they could do that. They could just vote them themselves. They could choose from a select set of third-party proxy advisors who put out guidelines that BlackRock would then vote those guidelines for the pensions, or they could just stick with the current arrangement in which BlackRock would vote the shares for them. I think this development is very interesting for a couple of reasons. First of all, I think it's part of a larger trend that we've been talking about here at this conference repeatedly about the turn towards populist finance. I think that there is more skepticism. Some of you, I think we talked about, the GameStop episode, an enormously important episode here in the US. I think also Engine Number One's hedge fund campaign that ultimately led to 3 dissident board directors being elected to the board of Exxon also played into this dynamic. I think that people are more distrustful of elites than ever. less likely to want to defer to corporate leaders or to defer to asset managers in exercising, say, in this case, over proxies. And so this move towards putting power back in the hands of the actual asset owners is happening everywhere. And I think that that's what this step is in part a reflection of. Some of it is undoubtedly also, I think, due to market pressures, competitive market pressures, and regulatory pressures. So let me say a little bit about that. So first of all, Robinhood, right, which is this online stock trading platform that has become very popular, particularly with Gen Z, as Konstantinos was just talking about. It was the vehicle or one of the vehicles for this whole GameStop episode, has been actively trying to put in the hands of individual investors their proxy voting powers. We've heard mention of a number of apps. It seems like there's a new app every week that is designed to put voting power back in the hands of individual investors, retail investors, pension investors. So everywhere we look, we are seeing this trend. And I think in part, BlackRock, which has to be looking to, millennial and increasingly Gen Z, how are they going to win them over? How are they going to win their business, get them invested in their 401ks, get them to choose their 401ks to be managed by a BlackRock as opposed to their competitors like a Vanguard or a State Street? Well, part of it is they're going to have to be able to say to their customers that they can offer this. Now, they don't do it yet. I want to be clear. This is not available by BlackRock at the individual kind of 401k level. But I think that this move towards empowering the pensions is a step in that direction. And I actually think ultimately, my guess would be BlackRock is going to try to go in that direction. I should say also there's another dynamic at play here. And the other dynamic is that BlackRock and others, like State Street and Vanguard, the big three, as they're called in the United States, which now own over 20% of the stock market, that now they're under some potential regulatory pressure, concerns about antitrust and so forth. So they're under increasing regulatory pressure, and so of possible antitrust concerns. So part of what's going on here too is by turning some of the power back over to their customers, back over to their pension investors, it's a way for BlackRock in a way to say, look, we are reducing some of our own power over the market, reducing some of our own say, putting it back in the hands of our pension investor clients. So I think that's part of what's going on here. I think it's an interesting step in the direction of a populist finance and putting power back in the hands of clients and customers and not intermediaries. The second point that I was going to make here was about the U.S. Department of Labor, new guidance on ESG. When we last spoke about a year ago, there was serious concern out of the Trump administration about new guidance and new regulations that would have strongly discouraged ESG and would have strongly discouraged voting by pension funds. Well, the good news is that the first thing the Biden administration did, or one of the first actions, was to say they were not going to enforce that guidance. And the second was to say that they were going to, the second I should say is this new proposed guidance that they have put out, which would not only reverse what the Trump administration did, but make it very clear that ESG considerations are appropriate to be considered by pension trustees in making investment allocation and other decisions, and encouraging these pensions to vote. So that's the latest. I'm not sure. Am I still on here? It looks like something was possibly disconnected, but I'm happy to say more, or if there are any questions about that.
You're still on, David.
Oh, I am still. Okay, good. Sorry. Well, then I will just make the one more that, just kind of close out the point, which is that, so now the Biden administration's Department of Labor has proposed this new regulatory guidance and reform to the rules that would actually go further than any administration has gone to date. in terms of promoting and saying that it is making it quite clear to trustees. Yes, ESG considerations are appropriate, climate change considerations are appropriate, may even be required. And so I think that this is probably the most significant change, pro-ESG change, coming out of a regulatory body in the US that we have seen in some time. So why don't I stop it there? I don't know if, I seem to have lost a little bit of visual here. So Konstantin, are you still there? Or?
I am still here, and thank you so much, as always, for a very, very interesting presentation. It's a great pleasure to share the floor again with you, David. And of course, while waiting for Nick, I can see him somewhere there in the corner in Paris. Let me just say that I fully share your views on the Generation Z, because I think that that's the new trend that we have to see. But again, it's once again the market initiatives that are driving the agenda forward, because when we keep on expecting from policymakers to connect the dots, if we can put it in these simple terms, and try to nudge market actors to communicate better with each other, we see that market actors themselves actually move always a little bit faster, and they are driving the agenda. So, for example, of course, we haven't seen how BlackRock will enable within pool funds, because we are discussing about full pool funds, of course, and we do not know how this the whole individualized preference will play out, and how in reality within pool funds these kind of expressions of opinions or preferences will actually be transformed into practices or actions and outcomes. But I think it's very good that BlackRock at least showed that, okay, I'm willing to, notwithstanding the fact that I'm operating within a pool fund, I'm willing to understand a little bit better of what each and every client wants. We cannot, of course, now predict what's gonna happen. But at the same time, in the UK, while waiting for Nick to come back to us, we also have other initiatives, more or less similar initiatives. For example, how we can enable within pool funds, pension funds to express their own views. So Minerva Analytics, for example, in the UK, with another company, developed a software that allows within pool funds for pension funds to express their own individualized opinions. And of course, then if we bring it down to the ultimate beneficiaries, the biggest challenge, as you mentioned very correctly, will be how we maintain the attractiveness of these funds towards the younger generations, who are constantly attracted by other much simpler and much more immediate and instantaneous investment solutions. There are many, and I could not even start now naming some of them, because we have many examples. Thank you, David. And the floor, Nick, the floor is yours if you want me to.
Yeah, because now we're moving from Scotland and Northern England. It's great to have you guys, because we have both, I guess, Boston, Glasgow. It's a timely moment to have you right before the Glasgow Forum. But we heard from two eminent legal and governance scholars. And so now we're moving from Boston and Scotland to Brussels, the European capital, in the person of Aleksandra, who will give us, I guess, the EU Paritarian, which is a progressive term in itself, because Paritarianism, which is a French word in English or whatever, means, as we said earlier, that there is a balance between labor and capital within the governance of these pension funds and insurance companies, which should please both David and our friend Konstantinos. But apart enough diversions and digressions, let's move right to Brussels and to Aleksandra.
Thank you, Nick. Thank you very much for the invitation. It's a pleasure, as always, to be here. It's a big learning experience, so very interesting intervention so far. So as Nick mentioned, my name is Aleksandra. I'm representing the European Association of Paritarian Institutions. So in the next 10 minutes, I'll tell you about a very positive development from our perspective at the EU level. The proposal of a social taxonomy, so the S on ESG, so the European Sustainable Finance Framework is really moving forward. So I'll give you some details on this, and I'll share with you also our preliminary perspective on what was proposed by the EU Platform on Sustainable Finance. A bit to complement maybe what Nick mentioned about the AEIP, the organization that I represent. So we're representing currently around 29 social protection providers, all Paritarian institutions as pension funds, healthcare insurances, and provident institutions. Paritarian meaning that within their managing boards, they always have this equal number of representatives of both employer and trade union side. So our main responsibility, of course, is their effective representation at EU level. So that's for the introductory part. Now coming back to the topic of today, I mentioned to you that I'm going to focus on the EU social taxonomy, the way it was proposed in July by the EU Platform on Sustainable Finance. Just to give you some preliminary points, a bit of a background on the EU Sustainable Finance Framework. I'm sure that more or less everybody should be familiar with these developments, but just to make sure that we're all working with the same context. So the EU Sustainable Finance Strategy, renewed strategy, was published this July. It's a very ambitious agenda linked with the EU Green Deal. It's also building upon the action plan from 2018 on sustainable finance. So now the EU has a very comprehensive set, let's say, of both legislative and policy instruments towards sustainable finance. At this point, we have standardization towards definition. So as of last year, already 1 year, we have the EU taxonomy on environmental, on the environmental side of things. So we have a good definition and a common understanding of what constitutes environmentally sustainable investment. And then we have also standardized processes, and I'm referring here to the mandatory regulatory regime towards disclosures. So we have also a sustainable finance disclosure regulation since 2019. A couple of other elements under disclosures are also in progress, but these are the most important points for now. So the EU Green Taxonomy, which is already operational since 1 year, aims to provide clarity for investors on what constitutes a sustainably green investment. It's a classification system in practice. And already since this action plan I referred to previously of 2018, we were also expecting a social taxonomy. And actually the social taxonomy was also referred to in the provisions of this green taxonomy I'm referring to also. So we were waiting for it for quite some time as an organization that represents pension funds and Paritarian institutions in general. Of course, the social aspect for us was very much linked to everything related to sustainability and to the definition of the green taxonomy. So in our input to the European Commission, we always stress that it's very important to see this as an integrated framework rather than two separate fragments. So we were very pleased to see that indeed they're also moving in that direction, and the proposal for the social taxonomy came up on behalf of the EU Platform on Sustainable Finance just this July. So at this point, it's not really a concrete proposal from the Commission. I want to make this distinction. It's coming just on the side of the EU Platform on Sustainable Finance. So it just remains to be seen whether there would be a EU taxonomy, EU social taxonomy, but it's still a very important milestone in the sense that it provides a bit of an orientation how a social taxonomy could look like. So this is what the European Commission would also consider. Just a brief overview on the main components of the social taxonomy, the way they're proposed by the subgroup of the EU platform that had the mandate to develop the social taxonomy. In terms of a structure, it follows quite a lot the structure of the green taxonomy. So in the sense that it starts with a broad definition of social objectives, then defining what contribution towards these social objectives would mean, and then applying criteria of doing no harm, basically the same that are defined in the green taxonomy, basically meaning that contributing towards one objective shouldn't harm the implementation of any of the others. The social taxonomy, it's important to mention, it's organized around a stakeholder-centric approach, meaning that it's in theory applicable to all sectors. So it doesn't have a service-centric or a product-centric approach, which would limit it to stakeholders or economic entities that are inherently social. So it has a broad approach, which from our perspective is a very positive thing. The social taxonomy also defines 3 objectives as social objectives. So starting with ensuring decent work, and here they have included everything around social dialogue, industrial relations, health and safety at work, these type of elements. And the second objective is promoting consumer interest, and the third one is enabling sustainable and inclusive societies. So these are the 3 social objectives included. An important thing to mention, and I'll finish here with this section on the elements of the proposal, but it's important to mention that the subgroup has differentiated between a vertical dimension and a horizontal dimension of the observed impacts that they try to create criteria for, where the vertical dimension is focusing on products and services. So basically, the contribution towards the social objectives that are defined is through specific products and services. And then the horizontal objectives is focusing on conduct, operation, and processes. So it's a bit more broad. So if we're considering human rights, for example, this will be part of the horizontal dimension, the way it's defined by the subgroup. And the horizontal dimension in theory applies to all sectors, whereas the vertical dimension is a bit more restricted towards services and products that are, again, inherently social by characteristic. So basically, the way it's defined between the horizontal and social, the horizontal and the vertical dimension, these are the two options for an economic entity, for a stakeholder to contribute to the social objectives that the subgroup of the platform defines. In terms of metrics, I think this is a very interesting element, since it's one of the big challenges when we speak about the S in ESG. Definitely defining indicators, meaningful indicators for measuring social performance of companies is something that's a lot more challenging than the E, for example. So in terms of concrete metrics, there's nothing concrete proposed by the platform. They're defining broad criteria about how the indicators should look like, but that must be a next step. So nothing concrete on that side. And then in terms of the link with the already adopted green taxonomy, several considerations are outlined in the report, but what seems to be the recommendation is keeping them separate. So keeping the environmental taxonomy and the social taxonomy as two separate elements, but creating a loose link in the context of basic minimum standards. So defining valid points for both that would then still imply that companies would report separately under both elements. And few words, hopefully I'm not overlapping too much with the next presentation, but a few words on our perspective on what was proposed for the social taxonomy. Overall, we have been very positive on the efforts of the European Commission to create this integrated sustainable finance framework. We think it's definitely important that the institutional investors participate and contribute to the transition towards the sustainability of the European economy. So we think there's, of course, a big role to play for pension funds and for the organizations that we represent. We have more comments on the operational side of things. So we don't have a position yet on this, but in any case, we have some common points to mention. We welcome the stakeholder-centric approach that the platform selected. We think it's very positive that they also refer to the European Pillar of Social Rights, for example, as one of the building blocks of the proposal on the social taxonomy. We think that this creates for a good integration between the different elements now that are part of sustainable finance framework. We welcome also the definition of the three objectives and the non-exhaustive list of the sub-objectives that are defined, especially those that relate to social and labor rights and the social dialogue. As a general comment, we always stress to the European Commission that pension funds need a lot of investment freedom. So, of course, they're active on financial markets with the only purpose of ensuring sustainable returns for beneficiaries, and they have a very important social purpose to complete. So in that sense, restrictions in terms of their investment behavior, we think it's not really the right way forward for the European Commission, but we welcome this type of guidelines and benchmarks and common targets towards the same sustainability objectives. So a last comment on my side, but something really important to mention from our perspective. So social matters in Europe are, of course, a competence of the member states. So as the report of the platform recognizes itself, there's some risk in the next steps in the process of implementation or developing the social taxonomy further that the EU would go a little bit beyond its competences. So we really want to put some safeguards there. And under the same argument and along the same lines, the EU member states have very different parameters in terms of economic and social development, and also in terms of what kind of policies and legislation exist on social protection and labor policies. So we want to underline that the starting point is different, and it's, in our opinion, very difficult and very challenging to set the same standards and criteria to measure progress towards the same objectives, especially when this concerns allocation of private funding, because eventually what, in our opinion, this could result in is major divestment from entire sectors or regions. And of course, this would make it even impossible for them to comply with the new sustainability requirements on the social side. So we see a big risk there. We think that there should be definitely some transition mechanisms to consider. And I think I might stop here probably because I don't want to extend too much, but I stop here and happy to answer questions.
One question for you quickly, because I think David needs to go. He left because David has to jump in a meeting in Boston, so we have many timelines. But a quick question for you then, what was the following, but I think, you know what? David needs to go, so can you stay with us, Aleksandra? Can you stay with us on the call?
Yeah, I can. Sure.
I kind of say, I think David has to go. So David just wanted to send some brotherly labor union or trade organization or labor capitalist, some brotherly labor capitalist greetings to Valerie and Chris here, from Boston.
Well, just obviously, labor's shareholder activism is a subject close to my heart and something I've, written quite a bit about. So first, just a general greetings. I don't know what the subject of your talk is going to be, so I don't want to derail. I guess one just quick update is, with so much talk about infrastructure investment in the United States, I think on the US side, this is an exciting moment. Hopefully it will happen with labor's capital, labor shareholder power being invested in projects that could potentially also lead to jobs for more workers, more union members, more contributions to pensions. So I know that this is something on the minds of a lot of US labor shareholder activists right now. And just a quick hello and a comment. I have no idea if that's what your talk is going to be about as well or not, probably not, but in any event, just saying hello and looking forward to your remarks.
Hello as well, David, and don't go away.
Yes. He needs to jump, but we'll see him, hopefully, we'll see him in the flesh in the spring in Paris, as we say. À très bientôt. À bientôt. Cheers. And so now quickly back to Aleksandra. Merci, David. So yeah, there was one question for you, Aleksandra, from one of the viewers or listeners, I forgot, because you mentioned several times the word stakeholders, which is a very nice word, but it can be vague and a bit like, political or sociological or whatever. So in Brussels, now, the stakeholding, whatever environment or milieu is becoming, complex and complicated. And there is, of course, in Germany, a change of guard, which may have an impact on the way, the European Council works. So without betraying any state secret, what is your feeling about the mood, the mood of pension and insurance stakeholders or Paritarian pension and insurance stakeholders in Brussels at EU level? What is the general mood now at this juncture?
That's a difficult question to ask because, of course, the situation across the EU member states is very different. The systems are very different, a lot of different developments impacting their operation. Or I would say that it hasn't been as bad as expected last year. So there was also maybe a little bit of a more positive expectation this year for growth. In terms of specifically the pension funds, I think there were a lot of policies foreseen now at the European level. So, of course, there's a lot of concern a little bit that the European Commission is trying to mingle maybe a little, to influence a little bit too much national competence. So we're also expecting to see how the new work program of the European Commission will define the relevant policies for next year. So I think it's just a period of expectation a little bit to see also how the current, the pandemic environment would influence operation at national level. So I think it's a period of a bit waiting to see what's coming up.
Okay, let's say cautious optimism. Also in Brussels.
Well, I tried to exactly formulate cautious optimism. I think it sums up right.
It's the catchphrase of the du jour, as we say in French. Great to see you. And now, without further ado, we're moving to Paris, where we